Good morning, everyone, and thank you for joining the Deloitte Non-Executive Director Technical Update. It's that time of the year, time for your flu vac, time for your technical update, and to get a bit of CPD under your belt as we head towards the end of the financial year. It is a miserable morning, so thank you for joining us. We have a good lineup for you this morning. We have Holly Keating, who's going to talk to you about sustainability assurance. Melissa Scully, who many of you will know, who's going to give us an update in relation to corporate governance and what boards need to be thinking about. And Oliver Holt, who many of you will also know, who's going to give us an update and indeed a reminder of things that we need to think about as we head into uncertain times. My name is Colin MacDonald. I'm a partner in Deloitte, and I'm here to bring us through the agenda and to hope that we capture some of your questions. We capture all of your questions as we go through the session. And to hopefully finish with a bit of time to spare to let you relax before your next meeting of the day. So with that, I will hand over to you, Ollie, just to bring us through the financial reporting update. And as I say, if people can put some questions into the chat, we'll pick those up at the end of all the sessions. So over to you, Ollie.
Thanks very much, Colin. Apologies in advance, the IT has been working for me very well this morning, so if I fade in and fade out, please bear with me. Hopefully it won't collapse. I've gone back to that age-old switch everything off and switch it on again, so hopefully we're back into some form of stability. More than I can say for our current economic environment, because we have had greater uncertainty and greater levels of volatility as the context for financial reporting for this season. And indeed, the need then for the audit committee to be very clear and very careful in terms of giving positive support to management, but also that challenge to make sure that the financial statements are doing what they ought to do in the context that we all have to live through the uncertainty and volatility. And that may well mean that the audit committee requires management, rather than just giving them one-point estimates, to actually look at various different scenarios. So therefore, this is a little bit more complex, and for management to say what's reasonably possible in terms of the different scenarios that could happen as the various uncertainties that I have on the slide here start to resolve themselves. We can see various different things happening, and it is, of course, always very important to distinguish between cause and effect. We know that there was an awful lot happening in terms of kind of inflation and interest rates long before the war in Ukraine. But that war in Ukraine has then added and exacerbated all those various different trends, and in particular the fault lines, both at a strategic level and now at a market level within energy markets, are all too clear to be seen. But now their financial consequences and how are they picked up. So again, that whole area in terms of financial reporting around judgments and estimates, impairments, provisions, looking at going concern, and all the disclosures around them now become very much front of mind, and the audit committee needing to challenge management. Have they done enough, and is the picture clear enough as it's produced in the financial report to cover things? So for example, we believe we're emerging from the pandemic, but there are many different routes that the pandemic could take. So have all those various different scenarios been thought about? Likewise, we've seen a lot of dislocation in terms of where markets are going and in terms of wider geopolitical risks, not least in our next door neighbours, and what that might mean in terms of the entity and where it's pointing at, and how all that's been taken on board. And indeed, as we've just heard from Holly, there's an awful lot to think about in terms of ESG and climate. And as Holly mentioned, there's a great need for the front half of the financial statements and the back half of the financial statements to align. And as we'll see later on, this has become very much a key message that we're hearing time and time again from IASA as the accounting enforcer, that they're not seeing enough connection between that front half and the assertions that are made as regards targets or climate commitments, and how that then flows back into the numbers. So there's an awful lot on that slide. I won't go through every single one of them, but it's all that's on the agenda and needs thinking about. So Ruth, if we move on to the next slide, I just do a very quick look at FRS 102. For those of you who are reporting in FRS 102, there is a bit of good news in that FRS 102 hasn't any radical change for your 2022 year ends. It is under review. There's a 5-yearly review cycle now taking place, and the FRC are looking at that. As you may know, earlier this year, the ISB published proposals to update IFRS for SMEs. So this will now bring us into the 3rd version of IFRS for SMEs, but they will spend at least 6 months, if not longer, deliberating over the feedback that they have, and they're not looking for feedback. The deadline for that is not in March of next year. So we are a good while away from seeing IFRS for SMEs. Nonetheless, we know the FRC are looking at the ISB's thought pattern here, and we are expecting to see a further exposure draft around changes that might be able to be brought to FRS 102 quicker than the timetable we have there for the IFRS for SMEs, and we might see some changes coming through for periods commencing on or after 1 January 2025. So we do have a good few years with FRS 102 as we now currently understand it. There are proposals out there for the expected credit loss model that you have in IFRS 9 to be folded into FRS 102 in some shape or form, but those proposals are probably well going to be delayed and possibly into the next review of the standard. The changes from the IFRS for SMEs in terms of how the ISB are incorporating IFRS 15 on revenue from contract with customers and IFRS 16 on leases into the IFRS for SMEs will also take to some extent the direction of travel and how that will also be done in terms of FRS 102. So certainly there is a feedback to the FRC that reporters expect to see some sort of change to FRS 102 for both revenue from customers and for leases, and in particular the notion of bringing all leases on the balance sheet. So we will see some developments in due course there. But for the time being, the good news is FRS 102 stays as is. If we move on to the next slide there, please, Ruth. In terms of new IFRSs for 2022, we have a fairly light year ahead of us, which is very good. The amendments to IFRS 16 for COVID were extended for a further year, so that's now in. In terms of 1 January 2022 years, if you have an owner's contract, just be aware that there's an amendment there that tells you to look at all costs of fulfilling that owner's contract. So in the past, there had been some reporters who had adopted an accounting policy of just looking at the incremental costs in terms of judging whether or not a contract was onerous or not. This amendment makes it clear that you look at all the costs that are required to fulfill the contract. So that would mean that even costs that aren't incremental, so for example, the appropriate proportion of depreciation on the machinery to fulfill that contract, that all has to be taken into account. So fixed variable overheads, not just necessarily incremental overheads, need to be taken into account in those calculations. We also have a change in relation to property, plant and equipment, where you might spend some time testing it, and as a result of the test, you produce some produce, and that produce then gets sold. Well, in the past, certain reporters might have had the accounting policy of deducting those proceeds from the cost of the property, plant and equipment. This amendment tells us that's not an appropriate accounting policy anymore, and instead IFRS 15 is applied, and you recognise any sale of produce as revenue as appropriate. Technical amendments there to IFRS 3 to make it cross-refer appropriately to the new conceptual framework that came in a number of years ago now. And then there are a number of annual improvements coming from the 2018-2020 cycle that are applicable from 1 January 2022. The first time adopted, they amended the rules for subsidiaries to make it a little bit easier for subsidiaries to get into the IFRS world. A technical change to IFRS 16 on leases to delete the example 13 on lease incentives, because that was capable of causing confusion. That's just simply been removed. And there's an amendment to IFRS 9 in terms of if you're changing your bank borrowings, shall we say, or financial liabilities, and it tells you how to apply the bank fees that arise in that instance in coming up with 10% test. So you remember, this is the test where if you're looking to see, is there a substantial modification, or if there's not a substantial modification to the particular financial instrument concerned, and how you deal with fees has now been specified in relation to figuring out whether the cash flows have changed by more than 10%. And then another technical amendment in IAS 41 in agriculture as to how you deal with taxation when it arises in fair value measurements. So again, you can see from the point of view of changes to IFRS is fairly much as to be applied for your 2022 year ends as you would have applied for your 2021 year ends. So there's good news in that. Moving on to the next slide, then you'll see that I've given you a list of various IFRS Interpretations Committee agenda decisions. So essentially, this is where somebody, whether it's an accounting enforcer, a regulator, or indeed investor or preparer of financial statements, brings a particular pattern to the IFRS Interpretations Committee and asks the Interpretations Committee what it thinks, and it can decide if the matter that's brought to its attention is sufficiently serious that it requires accounting standard setting, and therefore something that needs to get onto the agenda, either for an interpretation to be published by the Interpretations Committee or to be brought to the IASB as an amendment to accounting standards, or is it something that actually doesn't need to be brought to the agenda? So these agenda decisions are things that the Interpretations Committee decided not to bring to its agenda, but in making the decision not to bring to the agenda, when it publishes that notice, it often says what the gap is or how IFRS applies in the particular circumstances. And therefore, if you're in these areas, it's worth your while making sure that somebody in the finance team has looked at these and has appropriately applied them. So part of the challenge that an audit committee might have to management that's presenting financial statements for its review might be to say to them, have you considered the Interpretation Committee's agenda decisions, and are there any that are relevant to us, and how have you applied them? So there's a list there. Some of them are fairly minority sports. So the very last one there deals with something in the banking industry and a program that the ECB was running in order to give banks financing at particular rates. And then there's a whole issue about whether that was grant aid or whether it wasn't. And the IFRS Interpretations Committee looked at that. But across the patch, again, it's horses for courses, and whether any of these apply is something that you need to look at. The first one there in relation to demand deposits, that would be essentially where you have an escrow account, and the IFRIC, the Interpretations Committee, looking at this and saying if something meets the definition of cash, it's cash. So if it's on deposit and it's a plain vanilla deposit account, then it meets the definition in IAS 7 as cash, and it should be treated as cash. So certain reporters who mightn't have dealt with it as cash now find themselves having got to take an accounting policy change and taking a prior year adjustment where that's required. In relation to the negative low emissions vehicles credits, I'll draw that one to your attention, particularly because we mentioned again when we come on to talk to IASA, but essentially this was a situation where government said if you manufacture or import, let's call it fossil fuel motor vehicles, we will give you negative emission credits, but if you import electric ones or manufacture electric ones or what have you, we will give you positive credits. And of course, in this particular jurisdictions, people were manufacturing, importing, exporting, all that sort of stuff. And the question was put to IFRIC, how do you handle a situation where by the end of the year, you've actually earned yourselves more negative credits rather than positive credits, and do you have a liability to recognise? And of course, the Interpretations Committee had to go back and analyse through the scenario. If you have an excess of negative credits, in this particular situation, you have to make them good by having positive credits the following year. And if you fail that, then in the following year again, your access to the market will be restricted. So you actually never really wrote a check, if you like, in terms of something, the penalty or a fine. So hence the issue around whether or not you had a liability. The IFRIC landed on, looked at IAS 37 and the three conditions that are needed for provision, and in particular honed in on and focused a bit on whether you had a constructive obligation. So clearly, if your access to the market was going to be restricted to such an extent that you're no longer a going concern, you really need to think about what your obligations were. And then also in terms of having a constructive obligation, whether you had made any announcements to the market and you had created that valid expectation that you actually would fix the negative credit situation. So the possibility there of having no liability at all if you were never going to fix the negative credit situation. So a very interesting case, and one that IASA has focused on, which we'll come back to in a moment. So moving on then, Ruth, the FRC as our next door neighbour, if you like, in terms of an accounting enforcer, has brought out a number of different thematic reviews in the last year. So you can see that they covered the entire waterfront, whether you're looking at business combinations, deferred tax, or indeed talking back to Holly's session there in relation to making TCFD disclosures and how clients are reflected in the financial statements. And again, from an audit committee perspective, each of these reports can run as little as 30 pages, and some of them, especially where they include disclosures and so forth, to an awful lot more. But your whole concern and the whole, if you like, focus of these thematic reviews is applying the accounting standards as the accounting enforcer intends that they should be. So the challenge back to management is, have you considered these thematic reviews? How have you reflected them in the financial statements? And have you picked up the good hints and tips that are in these reviews in terms of making sure that you produce a set of financial statements that comply with all the requirements, whether that's in terms of the measurement, recognition, or disclosure. Moving on then, Ruth, we also have views on IFRS from the accounting enforcer, which we shouldn't ignore. In February of this year, they produced a compendium of financial reporting decisions that they had produced. And again, the theme from this is really, IASA has looked at a particular situation, and in a number of cases of reports, we've looked at the situation and we found it's fine and there's no issue arising. Or in other cases, they said they've looked at the situation and we find that such and such a thing needs to be changed, or something else could be clarified. So again, worthwhile asking management, have you looked at the compendium? Is anything there relevant, and have you appropriately reflected it through in our financial statements? If you are within the scope of IASA, you might be interested to know that last month they brought out a consultation on the publication policy. So where they are publishing these financial reporting decisions and are asking people to give comment. So that's something that you think might be worthwhile for you to engage in. I've given you the links there on the slide. And then finally, in terms of IASA, just earlier this month, they've published their observation document. And if we go on to the next slide, Ruth, give you a picture of the front cover there. And when you're looking at these slides, if you click on that, it should bring you directly into the document. It's only 23 pages, so it's a fairly quick read, and it highlights the matters that IASA thinks reporters should be considering for their 2022 year ends. And as we started this session with the uncertain outlook and uncertainties, IASA has picked up on that and highlights interest rates increases, first increase in 10 years, and expectations of further increases later in the year. And indeed, there is talk, as you know, of the 75 basis point increase before the end of the year. Inflation with domestic price increases at their highest level in 38 years, and indeed you do need to go back into the 80s and late 70s to find inflation in like we seem to be heading for at the moment, and that seems to be across an awful lot of the economies on the globe at the minute. And of course, as interest rates rise, growth forecasts are peeled back, and indeed there's talk of recession as we know, and therefore people having to fall back and being that little bit more careful in their analysis and that little bit more perhaps conservative in some of the estimations that might be made in the underlying assumptions, and also thinking very much about the sensitivities that might be disclosed, the basis for those sensitivities, and whether the range within the sensitivities are the correct ranges. So for example, you might have been happy to say in terms of interest rates, a sensitivity, possible increase in interest rates might only be 10 or 50 basis points, whereas now when we see ECB changing interest rates by 75 basis points at a time, you might be thinking, well, I need to make that sensitivity gap an awful lot wider. Moving on then to the next slide, in terms of this particular paper, they highlight various different areas, and you'll see this echoes back to the very first slide that we had in terms of calling out all the various different sort of areas of uncertainties that might be there. And then in terms of preparing the financial statements, watching out for all your significant judgments and those areas of estimation uncertainty and where key assumptions have had to change, and calling out and making sure disclosures really do deal with everything that the accounting standards expect management to deal with in making those disclosures. And at the bottom of the slide there, you'll see that IASA have honed in terms of alternative performance measures and making sure that the ESMA guidelines are picked up and are appropriately applied, especially if you take the performance measure that you had before and you now split it out because of these uncertainties or volatilities, and that you explain the use that's been made of it and why that split is necessary. So that brings on to exceptional item presentation and making sure that keeps within the rules. And also, again, talking back to, as Holly was talking to us earlier, that impact of climate change and making sure that there isn't any greenwashing. So that is not presenting something that has been huge and making a great change in the climate front, when in fact it isn't really moving the dial at all. So moving on to the next slide. In terms of the actual document itself, there are 11 particular areas called out, and you can see them on the slide there, where IASA give a little bit more colour in terms of what they're expecting reporters to do. So, for example, in relation to the war in Ukraine, it's telling reporters consolidation, the rules of consolidation are based on current control. So you might control the thing, but you still have current control. They also talk about things like expected credit losses and what's the appropriate expected credit loss to set, and so forth. There's a lot there. There's a lot in the geopolitical developments, which are talking back then to inflation and interest rates and so forth, and making sure that you distinguish between impacts if you're impacted by the war in Ukraine versus the impacts because of geopolitical developments. In terms of climate, this really does talk back to where Holly was saying about the front half and the back half, and IASA really saying they are focusing in and they are challenging reporters, and we see that challenge. And indeed, IASA have a separate publication out just saying here are all the kind of questions that we're asking reporters in the area of climate. And we see them, if you say in the front half, I have such and such a target and I will meet it by such and such a date, we then see the challenge coming through from IASA saying, well, you said you had a target, you said you're going to achieve it. So now that you've made those public declarations, where is your analysis under IAS 37 as to whether you've created a constructive obligation here? And do you actually have a provision you should recognise, or you don't have a provision that you should recognise? Given those targets and given the costs and so forth, should you not have disclosures around what that is going to cost you? Because a bit like a contingent liability, have you not said you're going to do these things? So should you not be calling out what it's going to cost? And again, it's that connecting the front half with the back half, and we're seeing a lot of challenges. So if you are under scrutiny from IASA, do bear that in mind. I just talked one other point in this slide, and that's the third last one there in terms of digital security disclosures and cybersecurity risks. As we know, this is a huge area, and only in the recent past we've been reading in the newspaper about Aer Lingus and people not being able to fly. No cybersecurity issue in that. Seemed to just be somebody digging a pipe in another country that affected the cloud provider that Aer Lingus was using, and therefore people couldn't fly out of an airport in another country. Showing that when you create very big complex systems, when you get a problem, you can get a very big problem indeed in somewhere where you couldn't anticipate. So that disclosure that's around the risks that are run, because business, like everywhere else, is now very much more digital and very much more digitally driven, and the exposures there are to cyber and so forth, is probably an area that needs a refresh if it hasn't had a refresh in your annual report, and to be looked at once more. And I think that's my final slide, Ruth.
And my apologies, I've already had some texts from people that I know wondering why I'm not wearing a tie. People will see that I'm dressing up. I've been wearing a t-shirt for all of COVID, so I put a jumper on. But next time I'll make sure to be suitably attired. Melissa, over to you. Hopefully your Wi-Fi is in Kildare is better.
Hopefully. Great, and good morning everyone. So for anyone that doesn't know me, I'm Melissa Scully, a Director in Risk Advisory and lead our Centre for Corporate Governance. So what I'd like to do this morning is really talk through a number of key themes and developments that we continue to see in the field of corporate governance. Some of these, they have been on both regulator, investor and board agendas for some time. So I'm really just going to talk through what we see as some of the key developments and talk about some of the drivers as well as the implications for you as board members. So the first area I'm going to talk about is board effectiveness and development. So the key trend we're seeing here is around enhanced practices and more increased disclosure around the subject. So as you'd be aware, an effective board is one that has a clear understanding of its responsibilities and the right enablers around it to support it and really have a positive impact in the organisation that it governs. In terms of board effectiveness, again, for quite a few of you on the call, you'll be very familiar with the annual review process that should be conducted internally and then supplemented with an external review every 3 years. What we've seen now is that it has become the norm for most boards to undertake this assessment. However, what we are seeing is that now that the expectations on the robustness of that approach has changed. So we're really seeing a shift from any boards that have been only doing a light touch survey, for example, to now really taking a more comprehensive approach and including interviews with not only board members, but also key stakeholders who regularly interact with the board. We're also seeing then investors and regulators more interested in the outputs. And I think one of the key trends we're seeing is really around the focus of the board composition. And there's now much more acknowledgement that the board and its skills is really critical to how it operates. So we're seeing more focus around board skills assessment and really looking at what key skills are needed. And some of those skills are indeed new skills than we would have seen a couple of years ago. So particularly around technology, innovation, sustainability, and then also in addition, specific market skills. We're also then seeing more focus on this area because again, some of the diversity efforts are lagging behind. And I think one also notable change I've seen in recent years is that for boards that have been progressing diversity, what we're seeing is that directors are coming from different pools, which is really positive development. However, what it means is that you now need much more targeted and focused approach on induction, training and development. So in terms of some of the implications, so what we would say is you really need to look at your practices around board assessment and make sure that they are evolving and that you're going beyond a survey to look at detailed skills assessments, observation and particularly case studies where you look at examples of some of the decisions that a board has made. So that's really a practical tip. Make sure that the assessment is also looking at softer areas, so dynamics, how the board is working, the leadership of the chair. And also another area, and one we do see in practice, is making sure that you aren't leaving the assessment to purely on an annual basis, but having regular check-ins. And then I think the last point I'll note is that particularly for any of the listed companies, we are seeing increased and enhanced disclosure around this. So actually, not only what process did you follow, but actually what are some of the outcomes of that. In terms of then another area which again continues to be on many radars is diversity and inclusion. So we've certainly seen much focus and emphasis on diversity, but I think inclusion is also really coming to the fore. So how are both staff and also new board members being made to feel welcomed, valued, and part of the culture. In terms of some of the drivers for this being a key theme, I think for any in the regulated sector, we continue to see this referenced by the Central Bank of Ireland. They're very clear that they see diversity and inclusion as critical to creating an effective culture. And we've seen a number of reports mention it, and they continue to refer to it in various speeches. I think another driver is just the historical lack of diversity and the amount of time that it's taking to lead to change. And it also continues to be referred to and specific initiatives set at government level. So locally here, we've got the Better Balance for Business report. And in the UK, we continue to see progress with Parker and the Hampton-Alexander reports. Also more locally then, this is bringing with it increased focus on pay equity, so gender pay gap reporting, and also again, similar to my point on board effectiveness, that we're also seeing improvements required on disclosures. So I think in terms of the implications for boards, we are seeing both targets being set and monitored at board level. And certainly if you are in the financial services, the central bank will be looking to see evidence of that in your board minutes and agendas. And we're seeing more board focus on actually what are those programs in place to really drive diversity and inclusion in the organisation. And also one other initiative we're seeing is actually more focused training at board and exec level. So just a few things to be thinking about. So then another area of focus, again, which has been, certainly it's not only a 2022 theme, but I think one we've seen certainly spearheaded a little around COVID times, but this is all around the focus on corporate purpose and social impact. So now there's more focus on the purpose of an organisation being there, not solely to make a profit or to serve one group of stakeholders, especially not simply shareholders, but really looking at the purpose of the organisation to make sure that it's serving the communities within which it operates. And there's been a number of drivers for this being a key topic and continued theme in corporate governance for 2022. And I think the first theme again is that it continues to be a focus for investors, regulators, and increasingly wider stakeholders. And I always refer back to the BlackRock Dear CEO letter, which really did initiate some change and an emphasis on this topic. I think also for many of you on the call, you may, as an organisation, be reporting on the SDGs. So we see then some of the sustainability reporting, which Holly's going to talk about later this morning, is really calling into question and focus the social element of ESG. So now we're seeing a lot of our boards and organisations looking at what they're doing around having a social impact. So some examples we'll see are financial inclusion, customer well-being, social partnerships, impact funds. And I think what's really interesting is we're going to see continued focus on this throughout 2023 and onwards into 2024, especially if you are listed, because this is an area that the next reform of the UK Code is going to cover, specifically looking at the responsibilities of the boards towards their expanded commitment to ESG and how the board is contributing to that. I think what I would also say is that I think we're going to see this continue also because of the cost of living and the energy crisis. So certainly it's a topic that's not going to go away. In terms of the implication for the boards, I think a few things I would suggest worth considering is really review the role of the board around sustainability and ESG. So it's not simply about the reporting angle, but making sure that the board is contributing and ensuring that the strategy and social impact is featuring on the board agenda. Often I think there has been a view around looking at this in terms of how those issues affect the business operations and their performance, whereas I think now we need more focus on actually the impact on broader stakeholders. And then the last thing I would say is really make sure that you're looking at some of your governance documents to see, are they really articulating the expectations that regulators and investors will want to see around this area. Another topic, and I'll only touch on this briefly because I think it links nicely to what I've just spoken about in terms of societal and social impact. But we have really seen a shift in corporate governance, and what I would say is we are in an era of stakeholder-centric governance, and that's one where boards, management, and organisations in general really need to think about all of their stakeholders when making key decisions. And we've seen a number of drivers around this. So again, I think it's expected from a number of stakeholders, but also we've seen some really fundamental failures where it's brought to light some of these issues. So the likes of Carillion and Sports Direct come to mind. Again, COVID has really brought this to the forefront. And as I mentioned already, we're also seeing much more public interest in this area. So again, from a board perspective, I think the key takeaway, I would hope the board members take from this morning's session is really to think about the importance of stakeholder mapping. So has your board looked at who its key stakeholders are and mapped out those that the board needs sight on in terms of the visibility of communications, the key messages to and from those stakeholders, and also then for those that are required to make corporate reporting disclosures or in the listed sector, really to look at how your disclosures tell that story of the board's level of engagement. And then I think also we have a number of participants today here in the financial services sector. So I think when we talk about stakeholder-centric governance and focus on stakeholders, I think it's really important to note that this is an area that from a central bank perspective, they're always really interested in terms of the focus of customers from our financial services organisations. So again, something that needs to continue to be front of mind for boards. And then just to touch on another topic we're seeing a lot more focus on at the moment is subsidiary governance. So this is really, we're seeing at a number of levels. So mainly at the parent level in terms of businesses looking to really ensure that they've got the right controls and governance over their subsidiaries. And I think this brings with it a real challenge of parent companies wanting to make sure that they've got the right level of control, but yet they're still providing sufficient levels of autonomy and agility at subsidiary level. So there's a number of drivers around why we see this as an emerging area of focus. And I think the one that stands out to me is that we are seeing more transformation, growth in M&A activities. So business models are changing, corporate structures similarly are evolving. And as part of that now, it's recognised that subsidiary governance is really posing a key risk to organisations. And again, often where something goes wrong, it tends and it has been seen at subsidiary level. And I think another area that I would note is that a lot of parent companies are now also looking at not only their subsidiaries, but their joint ventures or associate and other entity types to make sure they've got the right controls. So a few then thoughts in terms of implications. So consideration of your subsidiary governance framework and oversight model. So is it clearly articulated? Is it being assessed in terms of how effective it is? And also, is there clarity on the levels of authority, both at parent company level, what decisions have to be escalated? And also we're seeing them more focused on technology solutions to provide parent companies with the relevant assurance. So Ruth, on to my last topic, and I think for anyone in financial services, I think, I couldn't give an update on governance and not mention individual accountability. So we have now received the draft bill, and this continues to be an area where we're seeing boards continue to focus in terms of the plan to implement and look at the detail of the bill, and really a lot of focus around reasonable steps, frameworks, responsibilities maps, and making sure that the project and plan is in place. So a lot of focus on this area and continued momentum as we've seen the bill. So I think, Ruth, in the interest of time, that's my session, and I'm happy to take a few questions towards the end.
Yeah, and we'll gather the questions. So just a timely reminder for people just to pop in a question into the Q&A if they could. Holly, we're going to move to you. Oliver is still struggling to get online, so we're trying to get him on the mobile at the moment to see if he can join us. So we'll continue on in relation to sustainability reporting. Thank you.
Perfect, thank you. If we can go to the next slide, please, Ruth. Great, so good morning, everyone. I appreciate this is a very busy slide, and I guess that's probably the nature of sustainability at the moment. There's a lot of different acronyms flying around the place, and it's hard to understand what's relevant and what's not relevant for yourselves. So I guess when looking at this, the key thing is here is the green guys are the sustainability related items. So what this shows is just the different interactions between, from a global perspective, what different sustainability frameworks are coming down the track. So when we look at it from an international level, the ISSB, which is under the I4S Foundation, they're currently trying to adopt a global baseline of what sustainability reporting is going to look like. And the idea is that will be adopted by the local jurisdictions. So the UK have already signed up to say that they will be adopting this. And the idea is that that will be a global baseline, as I've said, and depending on what jurisdiction you're in, then you'll have add-ons. So within the EU and the US, you'll have different additional requirements. So this will be very much your financial reporting regulation rather than what, so your financial statements will be prepared in line with ISSB, for example. So when we move then to the US, any SEC regulated entities or subsidiaries of SEC multinationals will fall into scope of the SEC climate related disclosures. So that's just something to bear in mind. Those are actually coming quickly down the track. For FY23 will be the first year of them being applicable for those large accelerator SEC filers. And then when you look at the European Union, so we have a lot of regulations coming down the track there. So we have SFDR, CSRD, we currently have NFRD, and then there's the EU taxonomy as well that's floating around. So the big tickets that are there, I guess, is SFDR, which is already in place. So that's for the funds industry within Europe. CSRD, which will be coming down the track and we'll touch on in a few minutes. And then there's the EU taxonomy, which is not in itself its own regulation. So you won't be reporting on EU taxonomy if you don't fall into scope of the other European Union regulations. There are some voluntary regulations as well. So we have TCFD and GRI. So any London listed entities will fall into scope of TCFD for the current period. We can move to the next slide. Thank you. So I guess what this slide is kind of capturing is when you look at the funds industry. So there's an awful lot of disclosures that are required from the 1st of January 2023. So the funds industry is very much, the data is being brought together by the underlying investment portfolios. So you're looking at your EU taxonomy and your CSRD disclosures that sorry, I'm very out of breath. I'm currently dealing with a bit of a chest infection, so apologies for that. So I guess the key thing here is that for the funds industry, where they do have to report on an awful lot of information from the 1st of January, that's really what's driving the agenda for all of these local regulations. So for CSRD and for EU taxonomy, the funds industry will have to report what the underlying portfolio consists of, what the breakdown looks like in terms of the number of sustainable assets, the number of assets that they hold that fall into scope of EU taxonomy. So the data is very much early, but very much required very soon and very fast for the funds industry. So we might move to the next slide if that's okay, Ruth. So CSRD, I guess, is the big ticket that's coming down the track. And for CSRD, it's very much a wider scope from NFRD. So at the moment, any entities in scope of NFRD are public interest entities that meet a threshold of having over 800 or 500 employees, and then they have the turnover threshold of 40 million and the total asset threshold of 20 million. For CSRD, that scope is a lot wider, so you don't necessarily have to be a public interest entity anymore to fall into scope of CSRD. So CSRD will replace the NFRD regulation, so that's probably a good thing. There won't be two of them there. But it is something that will be a large number of disclosures that will be coming down quite quickly for entities. So you don't necessarily have to be listed or a public interest entity, as I've said. You do have to meet 2 of the 3 criteria. So either you have your 250 employees, or you have 40 million turnover, or 20 million of total assets. And the total assets point is probably important. It's not your net assets, it is actually your total assets. So that can be that can be a trigger for a lot of entities. So CSRD will be applicable for calendar year ends 2024 for reports issued in 2025 for any entities that are in scope of the NFRD. For any entities that fall into scope of CSRD that were not relevant for NFRD, meeting those threshold criteria, your first report will be for your calendar year end FY25 and your report issued in 2026. So I guess the main thing with CSRD is that it's slightly different from what the ISSB and the TCFD frameworks are looking like at the moment. There's a couple of different items in there, such as the concept of double materiality. So what that means is there's 2 sides to it, and it's a new wording, I guess, that the companies and directors will have to consider. It's not necessarily your audit materiality, which you would previously be familiar with, but what it is there's 2 aspects. So you have your financial materiality, which is the impact of climate change on the business itself. So for example, where you might have a risk of flooding, might that have a high value impact on your business? And then the actual impact materiality then is your business's impact on the environment and people in relation to climate change. So there's 2 aspects to it. CSRD haven't given any illustrations or examples on how companies can perform that materiality assessment, but we do expect that to be released by the end of the year. The other key thing with CSRD is that it is actually subject to limited assurance. So this is the first framework in Ireland that will be subject to limited assurance. So we have seen SFDR and the SEC climate regulations. They will be, so SFDR is subject to limited assurance in certain jurisdictions in the European Union. Within Ireland, it's not subject to it yet. So CSRD will be the first major one that will be subject to limited assurance. So I guess the one thing that we are recommending to entities is whether you do this internally or externally, but you start to do that gap analysis and readiness assessment over the next few years before you have to jump straight into your limited assurance in FY25 or FY26. We might just jump to the next slide, if that's okay, Ruth. So I certainly won't go through all of this, but I guess what this slide just does show is that for CSRD, there's a lot of different aspects to it. So for your SEC regulations, for example, they're very much climate driven. So you've got your scope 1, scope 2, scope 3 emissions. CSRD captures a lot more. So it does capture your social and your governance and your overall, your cross-cutting ones as well. So it's just something to bear in mind that it isn't just climate. When you think of ESG, there's other aspects to that as well that companies need to be aware of that is coming down the track. So I won't go through this slide. This is probably a takeaway, but this is a couple of key actions that companies can have a look at when you're thinking of getting ready for limited assurance, and some processes that you might start to implement internally, such as maybe looking at a roadmap. What does your overall operational structure and governance plan look like in terms of getting that information and that data together? So taxonomy, this, I guess, as I said, it's not its own regulation, but if you do fall into scope of your NFRD, SFDR, and CSRD, which are the European Union regulations, EU taxonomy is also involved in those disclosure requirements. So where you do have to disclose on those items, you will have to also disclose on the EU taxonomy. And what this is essentially is the taxonomy has given 6 objectives. There's currently only 2 live at the moment. So essentially within each objective, there is a list of activities, and companies need to perform an assessment to understand if their primary business activities fall into a bucket of these EU taxonomy activities underneath these objectives. So that's kind of the first step to understand if you have any eligibility towards the EU taxonomy in terms of those objectives. And then for the current period, companies will be starting to perform an assessment on alignment. So at the moment, the disclosure is only whether or not you actually are eligible for these activities. Next year, what you're going to be looking at for reports issued in 2023 is whether those activities are actually aligned with the EU taxonomy. And that process is a difficult process. So there's a lot that happens to perform that assessment. So there's a few things mentioned there. So it has to substantially contribute to one of those environmental objectives. It cannot do any significant harm to the other 5. And it has to also meet those minimum social safeguards under the UN. So it is quite technical. It's a difficult process. And we do recommend that clients are undergoing that as soon as they can. So for your SFDR, your European funds, they will be reporting from the 1st of January what their underlying portfolio looks like in terms of what companies are operating EU taxonomy eligible activity or aligned activities, and the actual companies themselves that fall into scope of NFRD will be reporting whether their activities are aligned with the EU taxonomy. For those entities that are not in scope until CSRD kicks in for them in FY25, this is a process that you'll be able to have an idea of how the rest of the market have done that for those in scope of NFRD at the moment. So it's just to bear in mind that it is quite a lengthy and difficult process, and probably not to kick the can down the road as much on this one. So that's just the applicable dates for that. So we can move to the next slide, please. As I mentioned, so for ISSB, this will be your global baseline standard. So depending on if your jurisdiction does in fact bring it in. But for ISSB, the idea is that it is very much going to follow the TCFD framework, which is already in place for entities that are falling into scope of TCFD. So that is if you have any London Stock Exchange listing for your entity, whether it's a primary or main market stock exchange listing for London, you will fall into scope of TCFD. This framework is very much going to marry up with that, and it is a process that's ongoing at the moment. It's not currently in place or finalized, but we expect something will be released before the end of the year. And so for a takeaway for the directors, some of the key focus areas, I guess, on what directors should be thinking about and debating is just in terms of these few items. They're certainly not exhaustive. There's a lot there. But from a governance and culture perspective, I guess it just means that there should be definitely a tone from the top, from the directors, that ESG is not a tick the box activity. It is very much a key action and agenda item for the board and the business. It should be an agenda item for all board meetings, whether that be from a strategy perspective or a reporting perspective or operations. It should very much be considered. For the conduct and disclosure piece, one key item is that I guess what we would recommend is that the board always have sufficient levels of expertise when discussing the regulations or the risks or the approach with management and the rest of the board. So it's just being very much aware, such as these kind of sessions, that the board are being upskilled in what's coming down the track, and they can appropriately challenge management on what they're doing and the disclosures that are required. From a strategy and a risk perspective, it is very much making sure that sustainability and climate is not necessarily its own standalone thing. It should very much be captured for the business as a key risk. And when you're looking at the financial statements, for example, it should not be only in the front half, but it should be coming through to the back half as well. So it's not its own separate item. It should be absolutely captured as the whole risk and objective of the company, that climate and sustainability risk is considered at all times. So those are the key items from me, Ruth.
That's great, Holly. I think if there ever was a reason to listen to the recording of a presentation again, I think our audience can put a towel over their head and re-listen to the presentation again. Certainly plenty there, and we'll come back to questions after, just while your Wi-Fi is still stable. Just in terms of as I listen and as we discussed earlier, it is time to dig out again the old recession manual and how we've done things in the past, as well as keeping one eye on the future and in terms of reporting. So time to work with your management auditors in relation to judgments and how we document those. With your experience in relation to that, what's within the financial statements that people should, outside the full annual report, that people should focus on now early to get auditors and themselves happy, or on the journey to happiness, for those with 31 December year ends?
But it is very, very much, as you know, Colin, every situation, and the devil is always in the detail in every situation. So those old chestnuts of making sure that everything is very much documented and thought through are where you fall back to in these circumstances, especially as recession is not necessarily a given. It's a huge uncertainty. There's an awful lot more volatility out there. Certainly, when you look at IMF, OECD, Central Bank of Ireland reports, they're all pointing that the risks are all to the downside, and it's very hard to find any good news. So that's the context in which we have to operate. Audit committees do need to be very supportive of management and do need to give them that positive challenge. And sometimes that positive challenge is, yeah, we've all smelt the coffee now, and we're now looking at to cover off the downside as well as being reasonably certain and dealing with the certainties, the uncertainties going out, while still putting a brave face in things. But we can't overdo the brave face. We can't all talk about the good news and ignore what's there. So it's that challenge to make sure that the balance is there, and to make sure that the appropriate areas that need focus get focus. So if we do think that there is a recession, so for example, because the cost of living rises across the patch, how exposed are we to that? And has that exposure then been carried through into value and use calculations, going concern projections, and so forth? And are they on the whole reasonable? So if somebody like IASA come in, and they're quite entitled to come in and actually ask to see the underlying document, would they say, yes, management did enough and did the right things, and the audit committee gave them the right challenge, so that they got there in terms of, yes, they looked at the possibility of recession and they dealt with it appropriately.
Yeah, the skill of judgment is back. Thank you, Ollie. And Melissa, as we look, and you look at boards, and a lot talked in relation about purpose over the last number of years. How are you seeing that iterate as we head into the winter of 2022?
So I think through a couple of ways, Colin. I think firstly is part of strategy discussion, so making sure that there is a clearly articulated purpose. Often you'll see actually companies have a very clear purpose, but they haven't defined it. So really stepping back and thinking about that. And then I think we're also seeing, I mentioned earlier, the importance of diversity. So I think, again, just looking at the skills of the board, making sure it really is representative of the stakeholders and wider community.
Okay. Thank you. And I think it's probably leaning into some of what Ollie's saying, is we need some grey hair around the table, if never before, as well, and how the board can support management at this particular point in time, as certain executives will be first time through something quite so different. Yeah. While recognizing they have the scars of COVID to teach them. And then Holly, I did mention an awful lot to do, and towel over the head time for directors. As you sit here today, is there one thing that you're from a lot of conversations you've had with an awful lot of boards and directors and executives over the last period, that you'd say directors are underestimating or not getting to first, that they should consider?
I think underestimating might not necessarily be the right word, because I don't think anyone is underestimating the volume of the regulations that are coming down the track. I think the thing to bear in mind is just that whilst it might not be immediate for you, it's probably something that directors need to be conscious that they're definitely focusing the business on addressing these items sooner rather than later. So I think the can't be kicked down the road much further on it. What we're seeing across businesses is that data is obviously very difficult to get, especially where you've got scope 3 emissions that you're trying to get from suppliers. So those conversations absolutely need to start happening. And directors need to just make sure that the company is focused on those items that might take a bit of time to get moving, so that when CSRD and SEC is very much in front of them, they have that groundwork done already, because that is a key focus item. The other thing is in terms of just from an operations perspective, making sure that the operational side of who's in charge of sustainability risk or the key operations of the business, that they do have communication with, say, the financial reporting team and things like that, because as you said as well, Oliver, where you have some key targets and emission metrics that you are including in your financial statements, you just need to make sure that the boots on the ground are very much following that as well, and decisions made there are reflected where you might have to consider if there's any impairments or contingencies. So I think it's just making sure that the directors are very much toned from the top. This is a focus now rather than in a couple of years' time, but I don't think people are underestimating it.
Yeah, I assume for your financials anyway, you'll need comparatives from the prior year, so, and then to test those for a year. So everything needs to be done sooner rather than you think.
Yeah, well, so we don't know that for sure. Some of the regulations don't require comparatives.
Okay,
Some
good.
of them they haven't clarified that yet. So for CSRD, we don't know the answer to that yet. But for some of the investment funds, for example, that will be reporting from the 1st of January, there's no expectation that they would have had a review of how some of their KPIs might have compared to the previous year. So it is dependent, and they all have different nuances. Unfortunately, there's no one rule for all of them.
Okay, so first step is to understand the scope of what you need to do and,
Yeah.
and really put a timeline in relation to that. Excellent. Thank you very much. My apologies to everyone that we ran a couple of minutes over. I hope you found it useful. We will have the recording up on which we'll share you the link after the session. And we're planning on another session in February. So we look forward to seeing you then. So stay safe and have a very good day. Thank you for joining us.